I wanted to make a really quick video on how you manage risk while trading options. Options are a little tricky because you can set stop losses just like you can on stocks, but it would have to be, based on the price of the option, which unfortunately doesn't always correlate with the price of the stock due to all of the Greeks. So it would be really great if you could set a price for the stock. If this were to drop beneath 450, sell my calls, but that's not the case. So most of the time we set stops based on the percent that we're willing to lose. um, but what you should do is sell your options based on the key levels that the stock is breaking. This goes with averaging down as well. So really quick on averaging down, if you had bought, on this breakout here, you bought calls here at 445, and you wrote it up here, and say you sold a couple but you're still holding some, and then it falls down, you wouldn't want to average down just on like some random candle. You really want to wait for a base to form, and you can see, okay, this is a key level, I think that this is bottoming out, now I can take my average down. You really want to average down at places where you would actually enter the trade. On a free falling candle, you wouldn't say, oh, you know what, I'm just going to randomly grab calls here. You would wait for it to hit the level that you want, and then you would enter the trade. You should treat it the same way when averaging down. It should be the entry to a trade as if you never had anything in there before. So with that being said, that's one of the most important things about swinging is averaging down at the correct time. And then when it comes to actually getting stopped out, say you're entering here, you think it's going to break out, and you take an entry and it fails its breakout. Well, you need to have a safety net set up where you're going to be selling your option. So you can see here, this level, this 435 area has been respected really well. There are a couple wicks down, but basically, if it were to drop under 435, you need to say, okay, now I'm going to sell. Now, what this does is it prevents you from, your contract could go down, 20%, and you're like, well, I don't want to lose more than that, so I'm going to sell it. But then the stock, just goes up because it wasn't breaking some key level. It was still kind of a valid trade, if that makes sense. So as long as this holds above 435, you should stay in the trade because it still is nice. If it breaks beneath this, then you can exit your option. And that goes with any trade. If you're going to enter on this breakout of Starbucks, maybe you entered, well, I guess all of these would have been an excellent entry. But if you had entered, on this candle here, let's switch down to a 5-minute or even a 2-minute and see what this looks like. So if you had entered on this candle here, thinking it's going to break out, and then it opens up here and closes down here, your contracts are probably down a decent amount. And that could make you want to exit. Let me just try to zoom in, sorry. So your contracts could be down, 20% from here, and, you should cut it, but the trade is still valid. I would cut it underneath this candle here at 112.41, which it tests over here, but it never actually breaks beneath it. And what that does is it allows you to stay in the trade, and it just continues up. And so this would be a highly profitable option. But this is your scare right here. And so that's why setting stop losses on options is very tricky, because you either pick a percent that you're unwilling to lose, and that should be relatively small. That way you can cut losses early and then re-enter and risk that same amount. And your total risk for the day should be, the same as one larger option trade, which would be what you should play on these, which is where you enter with a full position and then you respect the actual key levels of the stock. The only thing that sucks about this is you have to actually manage it visibly. You don't get to set stop losses. You have to actually manage the trade. So what you can do is you can set an alert for this area, and you know what, I can't do it because it's extended hours right now. But what you can do is you can set an alert here, so when it breaks that price, you get notified, and then you can sell your option. Realistically, you should do it a little bit higher so you have time when it does break that level to then access your option and sell it. But that's the way that you should be trading options. And again, they should be relatively small to your account, around 2% of your account value with options, and then risking a small amount from there. But yeah, always try to make sure that you're kind of operating within a key level on the options that you're trading. And then really quick, just to end the video, I would like to touch on Play, which is Dave & Buster's. And this is an incredible chart. So this month is already off to a bad start, but you can see here, sorry, that's curved a little bit there. You can see we have a extremely nice bull flag setting up. We have the volume profile on this side showing that this is a strong level for it. The point of control is down here in the 14s, but this is the second largest one, and it is right on this level at $40. As long as it stays above this, I mean, no reason why this should not be making new highs. So it will have resistance around here at $73, $74. But this can easily be a $70, $80, $90 stock if this monthly bull flag does break out. So excellent setup here on Play. And then the next one is NTAP. And I'm excited about this one, so I have my alerts set for this. This is dating back to the literal.com bubble, which is October of 2000. So you can see here, starts October 2000. This bottom point starts October 2002. So in 2 years, it kind of sets the tone for the next 20 years. And it is for you have one time here where it's like kind of breaking out this couple months. And then you have these couple wicks here. We have one full candle completely forming above this trend line. So if this were to actually break out this month, which July is extremely bullish, as we know, this can easily run up to 152. And so I say that based on these candles here. We have that starts at 44, runs up to 55, so it's a nice little $10 candle. We have 52 up to 67, and so we can easily get a candle running from 80. So you have to keep in mind that's roughly 20-25% value gain. So if we keep that in mind, this can be running from 86 up to 102 area, 105, and then the following month run up to the 120s. There's no reason why it can't do that. And so keeping this on watch, I have my alerts set. This is right a little bit beneath the actual breakout point. The alerts are set at 85-70 area. So I'll be watching this very closely. But excellent stock or excellent setup to be watching. And then really quick, just want to touch on the seasonality I'll check out SPY. And then let's adjust this to the last 10 years, 11 years. So you can see next week, 9 out of the last 11, or 91%, so 10 out of the last 11 years have been bullish for next week. And then for the Qs, we have a 73% chance at being bullish for next week. So we have a really good shot at being very green next week. So you could, if you're going to be swinging anything, tomorrow should be a great entry. And then you could swing those into next week and have a pretty good shot at being green. So that's going to be pretty much for SPY at least, pretty much the greenest week of the year now. Our first greenest week is over here in February. So next week should be excellent, and then we have a few awesome weeks towards the end of the year to look forward to. But keep in mind that next week is going to be very, very green, hopefully. So if you're going to be entering swings, tomorrow should give you a fairly nice entry. And you can grab some July 16ths or something, because you'll likely be taking your exits next week.